2023 on the back of reduced supplies due to adverse weather conditions which affected top producers such as Cote d'Ivoire. Gold prices increased by 29.4% to $2,641.5 per fine ounce in December 2024 from $2,035.4 per fine ounce a year earlier. In contrast, crude oil prices fell by 5.3% on a year-on-year basis to settle an average price of $73.2 per barrel in December 2024, following concerns over supply risks and the prospects of increased supply in 2025. The external sector position improved significantly in 2024 on account of an increased trade surplus and lower capital outflows. The current account recorded a provisional surplus of $3.8 billion compared with a surplus of $1.4 billion in 2023, driven mainly by higher gold and crude oil exports, as well as strong remittance inflows. This, together with a lower net outflow of $588 million in the capital and financial account, relative to a net outflow of $733 million in 2023, contributed to an improved balance of payments position for the year. The lower outflow in the capital and financial account reflects Ghana's successful debt restructuring and the IMF ECF program. These favorable developments resulted in an improved balance of payments surplus of $3.1 billion compared with a surplus of $518 million recorded in 2023. International reserves buildup was faster than programmed in 2024. Gross international reserves increased to a stock position of $8.98 billion at the end of 2024 and was enough to cover 4 months of import cover, exceeding targets under the IMF program. This compares favorably with the end December 2023 gross reserves of $5.92 billion. The cedi came under intermittent pressures during the first 3 quarters of the year, but regained some value in the last quarter of the year. Increased demand for foreign exchange to support energy-related payments, uncertainty around timelines on conclusion of the external bond restructuring, uncertainties around the Cocoa Board financing arrangements, and election-related jitters exerted pressure on the currency. And by the end of the 3rd quarter, the currency had depreciated by 24.8% on a year-on-year basis. In the last quarter, commercial banks' participation in the gold purchase program for foreign currency, positive sentiments from the progress made in the debt restructuring, and continued tight liquidity management caused the currency to appreciate. By the end of the year, the currency had depreciated by 19% against the US dollar. Summary and outlook. The committee noted that global economic conditions broadly improved in 2024. Global inflationary pressures have gradually eased over the period, which has led to easing monetary policy stance across several countries. Consequently, global financial conditions are expected to ease gradually as policy stances become more accommodative and inflation targets in advanced economies are met and expectations anchored. These conditions are expected to result in improvements in investor sentiments towards emerging market and developing economies. On top of the projected steady growth for 2025, the international markets have priced in a much stronger U.S. economy, stemming from the policies to be implemented by the new U.S. administration. This has already instigated a stronger U.S. dollar, with implications for emerging markets and developing economies, including Ghana. Complementary fiscal and monetary policies will therefore have to be carefully set to prevent spillovers to the Ghanaian economy. External sector conditions remain positive, with sustained stronger than program rebuilding of reserve buffers contributing to the stability of the domestic currency. The performance of the external sector was mainly driven by strong growth in gold exports, which also largely impacted positively on growth. In the outlook, the external sector is expected to remain strong as commodity prices remain favorable amid improvements in production. Overall, while the external sector conditions are expected to provide an anchor to exchange rate stability, key risks in the outlook, including challenges in the energy sector, will have to be closely monitored. The stronger than projected growth and generally improved macroeconomic conditions are spilling over positively to the banking sector. To sustain this effort, the Bank of Ghana will continue to ensure that banks with capital gaps adhere to their committed recapitalization plans to shore up solvency. Supervisory activities will be intensified to ensure that banks continue to address the high NPLs, which poses potential risks to the stability of the industry. The improvement in the domestic macroeconomic conditions is also expected to bolster debt servicing capabilities of corporate and household sectors, which would help mitigate further buildup of NPLs within the industry. The inflation profile remains elevated, largely driven by food price movements, especially in the last quarter of the year. The climate-related factors, including the dry spell in some parts of the food-growing regions of the country, and the late onset of rains negatively affected production, while supply chain weaknesses generally affected food prices. While the inflation outturn for the year 2024 deviated from target, it is expected that the disinflation process will resume, contingent on renewed efforts at fiscal consolidation, which is anticipated in the new administration's economic policy agenda and the yet-to-be-presented 2025 budget statement. The bank's latest inflation forecast shows a steady decline and return to the path of disinflation with an extended time horizon of achieving the medium-term target of 8 plus or minus 2%. Under the circumstances, the committee decided to keep the monetary policy rate unchanged at 27%. Thank you. Yeah, I think that we would keep it very brief today. This is the first Monetary Policy Committee press conference. We are in a situation in which, the government's economic policy is yet to come out. We know that the 2025 budget is yet to be presented, so we don't need a very long discussion of, monetary policy stance. Maybe when you come for the March meeting, you can ask all the questions that you want. Let me just use this opportunity to discuss the issue of the inflation outturn for 2024. And the point that you made, I think, was right. We started the year at 23.5 and we are ending up at 23.8. And so it appears as if nothing has happened, but it was not exactly the case. When we started the year at 23.5, inflation went up to almost 25 at the end of March. And we know what triggered the movement from 23 to 25 in March, mainly because of the way the exchange rate behaved. In the first quarter of the year, we saw some pressures on the currency, partly also because the central bank had a very aggressive target for building reserves in the first quarter of the year. So that contributed to the slight increase there to 25. And then between the 25 all the way to, I believe, August, inflation went down to 20% in August, and then we saw the gradual increase to 23.8. So it's been going in different directions. The explanations are very clear. The issue of food prices have, played a significant role. You talked about the structural factors. This is mainly what you see when you look at the food price behavior throughout the year. And the supply chain issues, transport prices, changes during the year, which fed into food prices as well. And then we also know that 2024 was an election year. And in every election year, the role of sentiments and expectations and those kinds of other things that you cannot easily quantify also drives the exchange rate. And therefore, you found that the currency remained very, very, very volatile during the year. And then if you look at the behavior of non-food prices, where monetary policy has a stronger impact on, you'll see that we ended the year at 20%, much better than the headline inflation number. And our interpretation of that was that, well, monetary policy did do its work in 2024. The problem that we saw was mainly a structural problem, as you identified, coming in from the food problem and the issue of the climate change issues that have impacted, food production in our country. Now, what does all of this mean going forward? I think this was the second part of your question. With the fund program, we have what we call the Monetary Policy Consultative Clause. 23.8 puts us just on the boundary of the outer band, I believe, which calls for a discussion, mainly a discussion with the fund on exactly what policies the bank would put into place to, drive us back into the single-digit trajectory that we are looking at. And as I concluded our statement, our forecasters are saying that instead of reaching the single digit by the first quarter of 2026, the forecast suggests that we will do that in the second quarter of 2026. Of course, all of that is predicated on the economic policy agenda, which is yet to be, crafted. So we have to make some assumptions that we would continue on the fiscal consolidation path, and the budget that will be crafted would respect, the parameters under the IMF program. And given that those parameters are respected, one can confidently say that the inflation profile would be close to what forecasters are saying.